Hi, I'm Christoph Gleisch, the President and the CIO of Harbor Capital Advisors.
Hi, I'm Spenser Lerner, head of the multi-asset solutions team at Harbor Capital.
And welcome to another episode of Views from the Harbor. Welcome to a really special episode of Views from the Harbor this week. You're actually going to see me disappear shortly, all right? And what you're actually going to see is a really, really special conversation between Spenser and the multi-asset group here at Harbor and an external speaker, an excellent external speaker, Bob Elliott, who is the founder, CEO, and CIO of Unlimited Funds. Prior to joining and founding Unlimited, Bob spent the best part of 15 years at Bridgewater Associates, the world's largest hedge fund, where he rose all the way up to the rank of deputy CIO. Bob is incredible at talking about the macro and just synthesizing an incredibly complex, dynamic system and all of the different levers and inputs. And it's a really, really great conversation. So please stay tuned and enjoy it. But before we cut to that, Spenser, you just had the investment symposium here at Harbor. Tell us a little bit about what is the investment symposium and what were some of your key takeaways?
Yeah, thanks, Christoph. So the Investment Symposium is a quarterly event that the multi-asset solutions team at Harbor hosts each quarter. It's a 2-day event. It's about 8 to 10 hours each day, and we really kick the tires on our asset allocation views for the next 6 to 12 months. So we go into the Investment Symposium with particular views, and then we usually host around 5 or 6 external speakers to come in, economists, strategists, our own internal sub-advisors of Harbor Funds, so we can get sort of some of the bottoms-up perspective. Yeah. And we really try and kind of evolve our views based on those conversations. So in this quarterly symposium, Christoph, as you mentioned, we had this great meeting with Bob Elliott and really excited to kind of dive into some of those specifics and some of the really interesting takeaways that our team had overall. I would say, to be concise, probably that there's a lot of optimism around inflation coming down in 2023. And the drivers of that inflation will be twofold. One is rents coming down as a lagged effect of spot rents today and also housing prices coming down. So there's a lot of optimism around that, as well as goods deflation, which we've actually seen in the last couple of prints. And there's just a lot of optimism that will continue to be the case. However, despite that, the underlying drivers of inflation driven by wage growth, which will continue to drive a lot of the services inflation outside of rents, that is still very much intact. And therefore, the Fed is still likely to remain very or relatively hawkish and keep rates elevated for next year. I'll just add one last thing that I thought was really interesting in our conversation with Bob Elliott, without revealing too much. You'll get more of the details in the next hour. But one really interesting thing that Bob mentioned was this idea that a lot of the disinflation that we're actually experiencing right now and will likely experience in the first half of next year is likely to be transitory. And I hate to use that word because it certainly has negative connotations after 2020 and 2021. But nevertheless, the goods deflation that we're seeing now and are likely to see over the next 6 to 9 months is a result of a very strong dollar, as well as a shifting of spending patterns from people buying goods in 2020 and 2021 to now focusing on buying services. And that's leading to this disinflationary impulse that is likely to reverse towards the end of next year in 2023. And so the way Bob put it was, inflation typically moves in sort of a cyclical way. It's not just straight up and straight down.
Yeah.
So we're likely experiencing a little bit of a down wave right now through the middle or so of next year, and then we'll likely see a reacceleration again in inflation, and therefore the Fed's going to have to stay tight.
Too many people celebrating or taking a victory lap of inflation, the battle having been won already. So without further ado, please Stay tuned. You're in for a real treat. And, welcome to this special session with Bob Elliott.
Thank you, everybody, for joining this week's Views from the Harbor. We are joined by Bob Elliott, who we're really excited to speak with, former co-CIO of Bridgewater. So I'm going to hand it off to Bob to give a little bit of his background and then talk to us about his views for how he thinks things are going to transpire for 2023. And then we'll just kind of ask some questions and have an interesting dialogue on markets. So Bob, I'm going to hand it off to you.
Perfect. I think before I get into the macro views, I think probably I'll introduce myself briefly. I'm Bob Elliott. I'm the co-founder and chief investment officer at Unlimited. My career has really been sort of 20 years as a systematic investor. I was at Bridgewater Associates, as you noted, for almost 15 years, where I was involved in creating a wide range of investment strategies across asset classes, and had responsibility for overseeing a substantial portion of the pure alpha portfolio. After I left Bridgewater, I guess it was almost 5 years ago, I ran a $125 million venture firm that systematically identified high potential early stage consumer opportunities. You could think about it like systematic investing, except in the venture side of the world using big data. And really my later time at Bridgewater, as well as my time in the private side of the 2 and 20 world, it increasingly became obvious to me that 2 and 20 asset management is really good for the manager and not that great for the investor. And the reason why that is managers produce really generally pretty good alpha, but they're also pretty good at taking that alpha away in fees, leaving investors not much better off than when they started, or how they can operate on their own. And so that really was at the core. The idea of Unlimited was to bring the concepts of low cost indexing to the world of 2 and 20, to create diversified, low cost, liquid ETFs that replicate the returns of 2 and 20 strategies in a form that is accessible to everyone, and is also much more tax efficient than traditional LP structures. Our first product is the HFND ETF, which has been trading for 8 weeks, has $50 million in it. One of the fastest growing startup ETFs, actively managed ETFs out there, certainly in the alternative space. And over time, we'll build a suite of ETFs that are fulfilling that overall vision. So you can go check that out. For today, part of our goal with Unlimited is to sort of democratize or bring access to more sophisticated return streams in an ETF wrapper. The other thing that we're really focused on is bringing investment insight, institutional and quality investment insight, to a broader audience. And so I thought this is a really good opportunity to talk with your team and also be part of the views from Harbor as well, to be able to sort of talk to a broader audience, because we really think that there's no reason why the everyday investor or all the great financial advisors that are out there in the world shouldn't have access to institutional quality insight about what's happening in the macro economy. And so today I'll give a quick overview of sort of where I'm seeing the world. A lot of the insights that you see here are drawn directly from the day-to-day work that I do on Twitter at Bobby Unlimited. So for those of you who've seen have followed me there, you'll see a bit of repetition, but I think useful to sort of bring the synthesis together. And for those of you who aren't following that, you can check it out on a regular basis, where you can get sort of real-time views of how I'm seeing the world. But let's get into it, right? So I'll start. We'll run through this pretty quickly, but my basic picture of what 2023 looks like, I have it here. The inflationary slog unexpectedly continues, which at its short, for a lot of folks, the inflationary dynamic of the last year has been quite a surprise. And I think the thing that and asset markets moved, and particularly traditional portfolios moved in a way like 60-40, in a way that was, not the inflationary dynamic caused a lot of pain for those holding traditional 60-40 portfolios. I think one of the things that's very important to recognize, and I'll go into the details, a bit more detail, is this sort of inflationary dynamic typically takes a while to play out. And so thoughts either that we're going to immediately run into a recession, a deep recession in the first quarter, or thoughts that we're going to go back to the disinflationary environment of pre-COVID, where 60-40 works well. I think both of those paths are not that likely. And so instead, what I like to describe it as is the inflationary slog continues, and that has a number of implications for asset markets. So let's get into it. If we look into the major developed world. Yeah.
If I could just real quick, Bob, I think we very much see eye to eye on your thoughts around the 60-40 portfolio, and our CIO, Christoph Gleisch, dubbed 2022 the year of the 60-40 crash, and that we think that will have significant implications going forward in terms of how investors should think about their portfolios and other types of non-traditional assets to incorporate. So very excited to hear about your thoughts on that.
Yeah, and I think this idea, that, we had a crash of the 60-40 portfolio. If you go through September, right, 60-40 was down almost 25%. There's been a bounce here in the last couple of months. There are, you could look at that bounce and say, oh, let's just go back to, 60-40 is okay. Why don't I just continue to do what I've been doing with 60-40? Or what you can do is use that bounce as an opportunity to improve your diversification so that you don't get hit with a similar dynamic again in the future. And that's what I think it's actually a really, today as we do this just after the CPI report on December 13th, I think is actually a uniquely opportune time to add diversification to your portfolio. So let's get into it. The macro backdrop here is that the major developed world economies continue to experience moderate growth, low unemployment, and inflationary pressures. The composition of those inflationary pressures are a bit different than they were, say, 6 months ago, in the sense of we're having this transition from a set of inflationary pressures that are mostly focused in the goods sector that are a function of supply constraints, to one where we're starting to see increasing pressures emerge in the services side of the economy and a broader set of the economy. And that's important because services inflation, wage inflation, is a more durable dynamic than is goods inflation. When we look at how most markets are priced today to end the 2022 dynamics, which is very different. We're sort of saying the macroeconomic dynamics are that those 2022 dynamics will continue to play out. Most markets are pricing an end of that. I'd highlight that hedge funds have navigated this period in 2022 very, very effectively. But the way that they have done it is by playing defense very effectively. And when we look at what they're doing today, they remain conservatively positioned. So the most sophisticated investors in the world are very conservatively positioned. And I think a very important opportune time here where we can use tax loss harvesting to improve your portfolio diversification before we start to see another leg of this dynamic play out. Let's start with the U.S. economy. The U.S. economy is doing pretty well. And that's important to recognize. Unemployment is at secular lows. GDP growth was a bit softer earlier in the year and has rebounded. The labor market shows very few signs of any deterioration. And really, when we look at what's going on in the economy, despite the fact that we've had almost 500 basis points of short end tightening plus quantitative tightening, really the only sort of key cracks in the economy that we're seeing, they're pretty concentrated in New York and San Francisco tech, the New York and San Francisco tech scene, and not even yet getting into the housing market and construction and things like that. And so when we look at the economy overall, it's a pretty good economy operating at relatively high levels. The result of that is a dynamic where we're seeing pretty good wage growth as a function of the tight labor market. So on the left-hand side, what you see here is The employment costs index, which gives you a sense as to what wages look like, they're growing pretty well at sort of the 5 to 6% range. If we triangulate across a bunch of different measures, all of them basically say wages growing at 5 to 6%. And then what that's helping is it's helping create a fair amount of nominal spending. Now, nominal spending was elevated in the first half of 2022 because of elevated inflation and households continued to consume. But what they did was draw down savings. And so what you see here on the right-hand side, the red bars are the nominal spending, the blue bars are the real spending. And so in the first half of the year, in the high inflationary environment, households drew down savings to maintain high nominal spending but had very low real spending. But as goods inflation and things like gas prices and other goods have started to decline, what we've seen is that households have continued to spend in a nominal basis. And the reason why they've continued to spend on a nominal basis is because of this dynamic here on the left, that nominal wage growth is pretty strong. And so they've maintained nominal spending. And the function of that is actually to improve real spending. And the fact that we've improved real spending now has created an environment where the economy is likely to grow even stronger, because real growth is being supported by a combination of high nominal spending and some moderation in inflationary pressures.
Hey Bob,
yes.
How much, if you go back, how much of that do you think is driven by the elevated wage growth and therefore elevated nominal incomes that for most of this year have been running around 9%, versus how much of it do you think is from the excess savings that, earlier in the year was over 2 trillion, that as of today, I think sits at closer to 1 trillion, or is it both?
Yeah, I mean, the way, if you see here, the average of these parts in the first half of the year, it required a fair amount of drawdown of that savings because incomes weren't quite growing fast enough given the nominal spending that was going on. But I think the thing that's very important to recognize here in this last couple of months is a much more normalized set of behaviors where you've seen nominal spending fall to, say, 8. You continue to see a bit of a drawdown in spending, but that's a more durable drawdown in spending because wages are improving as a function of the tight labor market. The drawing down of spending is moderating. Total nominal spending is easing a little bit, but because we've seen a decline in gas prices in particular, real spending has been able to rise. And so we're not, the nominal spending, the drawing down of those excess savings, that's going to take a little while. There's still a fair amount of that left, is the short story. You say $1 trillion, maybe it's $1.5 trillion, but it's going to be, that's a fair amount of spending down that it could occur over the course of 2023. And remember, wages continue to have upside pressure in the economy given how tight the labor market is. And so, this is certainly sustainable for 9 months, maybe even a year, this sort of rate of nominal spending, which, to be clear, for those people who are saying there might be a recession afoot immediately, it doesn't make any sense because the consumer can keep spending like this. And if anything, their real spending power is increasing, not falling. I think it's important to recognize as we look through the path of inflation, I love looking at wages because wages in many ways set the baseline, the structural sense of what's going on in inflation. And what's happened is inflation was very elevated earlier in this year because incomes were growing reasonably, and then excess savings or excess spending happened as a result of drawing down savings. Now that's easing off, and the sort of baseline of spending in the economy is that 5 to 6% nominal. The interesting thing about that is that's compared to a productivity growth number, which is essentially 0 and has been 0 for a long time. And so you basically have the situation where you'd expect prices at the aggregate economy level to run about 5 to 6%, given that dynamic of wages growing the way that they are and productivity going the way that it is. But then what's happening is people are looking at measured inflation, and that measured inflation, I think, is confusing people. And the reason why it's confusing people is there's a lot of cross-cutting things that are going on. So here, if we look at the left-hand side, what we see is a breakdown of core CPI into the key components. Core goods, which you see back here in the darkest line, were growing very rapidly, core goods prices, and have now shifted to falling, which has been a big disinflationary impulse. Shelter, which is kind of running at an elevated level, moderated a touch. And then services ex shelter, which has actually been running a tad soft relative to what you'd expect. And so what you're seeing in this overall dynamic is basically a big disinflationary impulse as the issues related to supply chain problems start to resolve themselves. We're going from an inflationary impulse to a disinflationary impulse with goods. We're probably seeing the peak disinflationary impulse in right about now in the market, and we'll likely see this situation go up over time. And at the same time, we're starting to see wages flow through to services prices, and I think that's what you see over here on the right-hand side, which I think is very interesting. If we just take the services side of the economy, I actually kind of like this chart here on the bottom right. This is the wage part of the CPI, where wages are driving, services part of the CPI that's driven by wages. What you see is actually on a short-term basis, we're actually basically near highs in terms of the wage-driven part of the CPI. But if anything, we'd be a little bit stronger if not for some medical services issues, which I won't get into the details of. But basically, there's been a pretty significant and odd decline in medical services. This is beyond the insurance issue, which sometimes is on headlines, which doesn't seem plausible that this will persist, given that medical wages are growing at 8% a year. And so what we're seeing is we're going to see this very interesting dynamic with inflation playing out over the course of the next 6 to 9 months, where the services inflation dynamic is rising, the disinflation that's coming from the goods part of the economy is hitting its max disinflation. It'll moderate. Housing continues to be relatively elevated, and so we're probably getting low CPI prints for a couple of months. But if you go 6 months forward and those goods prices shift from disinflation even to flat, you're likely to see a situation where you'll start to get back to elevated inflationary pressures, elevated reported inflation, out somewhat like 6 to 9 months from now. I'll talk about the rest of the world. The rest of the world is basically in the same place to sort of oversynthesize it, but I think it helps sort of give you a good sense as to what's going on. If you look at growth across the European economies, Germany, France, Spain, Italy, UK, it's fine. Like, these economies, they're not booming, but they're growing fine. Tales of a depression in Europe are overstated. And you look at their inflation, you look at their unemployment or their labor dynamics, and what you see is secularly low unemployment for the core economies. And so in the same way that the US is seeing a situation where we have secularly low unemployment, reasonably healthy growth, increasing wage pressures, we're seeing basically the same dynamic in the European economies. And so over here on the left, what you see is measures of underlying inflation. Some people talk about, well, Europe, the only thing that's going on in Europe is a story of input costs, energy costs, things like that. No, that's not true. Like, inflation has become entrenched throughout the economy. You can see all the different measures of inflation way beyond just the headline inflation number in the European continent starting to rise. Here, what you're seeing is that 80% or 75% of the categories in inflation are rising faster than 3%. If you go to the UK, which is what this lower right chart is, you can see that services contribution to inflation and things that are not, the core electricity and gas parts are starting to rise more and more. It's not just an energy story. And so you're starting to get this permeation in the same way you got a good shock in the US driven by supply chain issues, then flowing into rising prices throughout the economy and rising wages in response to a tight labor market. You're seeing basically the same thing play out in Europe and the UK. So you've got this broad inflationary pressure in economies that are growing at a reasonable pace at relatively elevated levels and secularly low unemployment. And typically, what that would mean is you have inflation for a while, that you have to have relatively substantial tightness of monetary policy in order to break the labor market, in order to weaken the labor market, in order to then start to reduce wages, in order to reduce prices. But instead, and that in a typical macroeconomic cycle takes a few years to play out. But instead, what's being expected across the US, Europe, and the UK is that everything's going to go back to 2% in basically 12 months. And so that's what you see over here on this top right chart. This is shows you all the different periods where inflation reached 8% and how it typically plays out over time, the 0 point being when it reaches 8%. Typically, it takes a while for inflation to fall. Even in relatively positive environments, right, it takes years for inflation to fall back to something like 4%. But instead, what the expectations are, and if anything, the rise in both Europe and the US has been more aggressive than typical. But instead, what's expected in the US and in Europe, and then here below, this is for the UK and what the Bank of England's projection is, everyone is expecting immaculate disinflation. That we will have a disinflationary dynamic that will emerge over the next year that will bring inflation back to 2% in a way that has never happened before for economies facing this level of inflation. And that is a very low probability event. Yet, that's what they're pricing. They're pricing immaculate disinflation with no growth slowdown. And so if you look at the inflation swaps curve, this is from yesterday. This actually come in a fair amount since yesterday. It's even lower since yesterday. You see 12 months forward inflation, the inflation swap curves to be, pricing at basically 2.5%. You see longer dated, whether it's the 10-year break-evens or the 5-year forward break-even. You see those are basically between 2 and 2.5%. And all of that is in the context of a stock market pricing that basically, while stocks have gone down a little bit, they actually haven't gone down that much relative to the rise in discount rates. That's what you see here. The blue line is the total stock market. The gold line is would be the impact from rising discount rates on the stock market. And if anything, actually, what you've seen is stocks have done a bit better than what you would have expected given the rise in the discount rate. And so you basically are painting this picture on a forward-looking basis that we're going to have inflation go back to 2% durably in a way that's never happened before for economies facing this dynamic. And that's going to happen in the context of the fact that stocks and earnings are going to be just fine. And those two things cannot exist at the same time. They will not exist together. Either you're going to get lower inflation through a weakening of the labor market, weaker earnings and lower stocks, or inflation is going to be higher than currently priced because the economy is not going to weaken as much as is necessary to bring inflation down to that 2% level. And so what you see here is this. So that's sort of like the macro bond market, immaculate disinflation being priced in. And then you go to what's being priced into monetary policy. And what you see is that basically the expectation is it's over. So despite the fact that inflation and wages are running the way that they are, both in the US and Europe, the expectation is we're on the fast track to peak tightening, and to cuts in the near term, right? Cuts on the second half of 2023. And that seems like a very low probability event given the tightness of the labor market, given the inflationary dynamics that we're seeing across these economies. I mean, look at Europe. It's expected to have peak rates at 3% in an economy that is facing 10% inflation, right? I mean, that is an incredible 10% inflation, secularly low unemployment, moderate growth, and rates are going to peak at 3%. Like that seems like an incredibly low probability outcome given that set of dynamics. So too does the hundreds of basis points priced in to cut in the U.S. over the course of the back half of 23 and in 24.
Do you think that Do you think that part of the problem or part of why what markets are pricing exists is because they're misinterpreting or mischaracterizing a reversal of the supply shock that we experienced during the COVID pandemic? And, a supply shock will send real GDP lower, and it will increase inflation just based on a reduction in supply, but nominal GDP theoretically should stay pretty similar. That's obviously not what we've seen, but a supply shock has been part of what's happened. And so a reversal of that over the last year, which you can see through freight rates coming down, and the New York Fed measure of supply delays and issues, and that measure has also come down significantly in various other surveys on port congestion and things like that. So as you get sort of this reversal in the supply shock, real GDP should move up and inflation should move down. And then when you add to that, there are some other kind of shorter term cyclical dynamics, which I think what you alluded to before, Bob, specifically, if you think about the drivers of goods prices, just let's say from a US centric perspective, a stronger US dollar is going to weaken international export demand. And so that's going to bring down goods pricing in the US, and elevated inventories at retailers and wholesalers and distributors. That will bring down goods prices. But there's sort of a shorter term nature to that dynamic. It's a bit more kind of short cycle. And so there's a deflationary or disinflationary impulse from the reversal of the supply shock, as well as some of those other impacts on goods. But then you could even add to that the housing dynamic, because there's a lot of there are various measures that are showing, like the Zillow, for instance, new market rents and things like that are pointing towards market rents starting to fall and fall pretty aggressively. So do you think that the market is seeing some of these things, and assuming that the disinflationary impulse that we're experiencing now isn't sort of like a near-term phenomenon, but that it will persist, and that overall inflation will just stay at 2% during this disinflationary backdrop that we're experiencing right now? Whereas it sounds like from your perspective, you think that disinflationary impulse will exist for now, and we're sort of seeing the peak of it, and it'll start to decline, the impact, over the next 6 to 9 months. And then coming out the other side of that, I guess you could say, ironically, there might have been some transitory inflation, and now there's some transitory disinflation.
There's transitory disinflation. That is exactly what's going on.
You think the market's missing and they don't see it as transitory?
Well, I think, if you look at this chart here on the left, I think people are looking at this chart on the left and seeing the disinflation particularly caused by core goods, let's say, so like used auto prices, and they're saying, oh my gosh, look at that, we're on a disinflationary path because I'm seeing those prices decline. And they're extrapolating that this is going to continue to fall over time, and not recognizing that in order for those sorts of goods prices to continue to have the same disinflationary impulse, they have to continue to decline at the same rate. So take used autos, for example, right? This is I don't want to get too geeky about how exactly to think about this, but I think it's important. Used autos right now are falling at faster than a 30% annualized rate. Now that there is a limit to that, right? Used auto prices are elevated. There's no question about that, but they can't fall at a 30 or 35% annualized rate forever. In fact, there's actually some signs that used auto prices are starting to fall at a meaningfully slower pace in November, right? And so if used auto prices fall at 10% annualized rate instead of a 30% annualized rate, what happens is this disinflationary pressure starts to moderate, right? And at the same time, that is happening at a time when the services side of the economy, which is driven by wages, is continuing to inflate or remains relatively strong because the labor market's strong, because wages are strong, because incomes are strong. And so I think the thing that we're seeing amongst how people are viewing the inflationary dynamic here is they're not viewing it as a series of evolutionary dynamics, transitory inflationary, transitory disinflationary, to zero, with wages kind of continuing to go up the whole time. They're not viewing it as a moving dynamic like that. They're like they're not seeing it enough in terms of how it's going to move through time, and instead either extrapolating or just looking at the spot picture and saying, well, inflation's been, below 2% headline for the last 3 months. So, this inflationary problem's over. They're not visualizing how all those things are going to interact with each other.
Yeah, that makes sense. Do you think that the FOMC and the Fed will view what's going on under the surface more accurately, or do you think there's a chance that they could sort of blink and see inflation give a handful of month-over-month prints that are pretty weak, and ultimately do us a disservice, because that would probably reaccelerate inflation? But I know that the as you alluded to earlier, markets are showing that markets are expecting the Fed to cut rates next year. Do you think that this transitory disinflation could lead to that kind of an outcome, or is that unlikely?
I think the Fed is. There's been many cases in which Chairman Powell, for instance, has highlighted the wage issue, and I think that's because he knows that structurally there can be a lot of movement in gas prices, there can be a lot of movement in used car prices and all that stuff, random medical insurance measures, all that stuff. He's like, wages versus productivity equals prices. Like he understands that core fundamental dynamic. And so if that's the case, if he understands that core fundamental dynamic, I think he will be hesitant to give in to transitory disinflation, particularly since he got burned by transitory inflation, right? So I think he's going to be slow to get on board and extrapolate what is probably transitory disinflation in the market. And so I think that's, odds are more likely what we're going to see, and we're going to see 50 tomorrow probably. It would be odd if they did something other than 50 tomorrow. We might see an extra hike or two, but of smaller size. I think there is a reasonable prudence, given that inflation is starting to moderate and they've tightened a lot, to sort of take a break for a little bit, to ease off, given the balance of pressures that they're seeing, and see whether they're getting enough labor market deterioration to then create a situation where wages are starting to fall. I think they're not going to get that. And if anything, all financial conditions today are more stimulative than they were 6 months ago. That's important. Financial conditions today are meaningfully more stimulative than they were 6 months ago. And so what's going to end up happening is they're going to reasonably pause in response to backward-looking information of moderating CPI and the fact that they've tightened a lot, which creates, or in the context of this stimulative set of financial conditions and continued tight labor markets. And so what they're going to see 6 months from now, they're going to look back and they're going to say, oh, the economy's actually been very strong. Wages continue to be relatively strong. Those transitory disinflationary pressures are starting to reverse. Inflation is starting to emerge again. Oh, I see we probably haven't tightened enough to break the back of inflation. And so then they will restart their tightening cycle. And so that's where, when you compare the pricing, when you look in the back half of 23, it doesn't make any sense. The odds that the Fed is going to deliver 50 or 75 basis points of cuts in the back half of 23, given where the labor market is, given where financial conditions are, given the transitory disinflationary nature of goods prices, given where wages are, it seems very, very improbable that that's going to be delivered. But you have to visualize how all these things are going to move together through time and intersect with each other, and how the Fed will respond to those things to be able to effectively visualize what that's going to look like. Because if we go back to the title of the whole thing, the inflationary slog continues, right? That's what we're likely to see, right? Is the inflationary slog continuing, more of the same. And I think investors are unprepared for that, because they're unprepared on the bond side, because they're holding bonds in an environment where you're likely to get tighter than currently priced in monetary policy, and they're holding stocks which is reliant on easy monetary policy that is not likely to transpire, I think ultimately what we're going to see, maybe it's in the back half of in the later part of 23, but if those inflationary pressures continue to exist broadly in the economy, the Fed is going to have to tighten even further than it already has and lead to probably a worse recession than what most people are expecting. So it's like a late bad recession to kill inflationary pressures, something like 9 to 12 months forward. That's a pretty tough thing for people to put in their heads and navigate through over the course of the next year.
And Bob, when you're doing the math, when you're looking at the various signals to inform you of if, let's say 5% on the Fed funds rate or close to that in terms of what's priced for the peak rate, what signals, what lends itself to you to think that will not be sufficient? Because I can certainly point to plenty of lead indicators that would suggest that recession and that weakening in the labor market is likely to occur next year in a significant way, whether it's the breadth and broadening and depth of the inversion of the yield curve, or housing really at this point sort of plummeting, real money supply turning negative, banking deposits, falling and coming down at a pretty significant clip from QT. There are all these different leading indicators that historically have had pretty high hit rates. What is it that you see that, and I guess probably part of that is still the high levels of nominal spending, but what in aggregate are the things you're looking at that tell you that what's priced now probably won't be enough to break the back of the labor market and therefore wage growth?
Well, I think it highlights many people have, basically no one who's right now has lived through an inflationary cycle. And when you have a more typical inflationary cycle, which is driven by income growth and tight labor markets, different from a credit cycle, the lead lags, what drives what's happening is different. Because typically what happens is you get interest rates rise, credit falls, spending falls in interest rate sensitive categories, and that then goes back all the way to employment. So employment's sort of the last thing that happens. But
right.
But that's when credit is the primary financing of the marginal spending. There's basically been no credit boom here in this cycle. This has been a fiscal transfer driven, income growth driven cycle. And so in order to understand what's going on with that, you got to go back to looking at what's happening with wages and what's happening with excess savings, right? And that's where this cycle starts, because those two things will determine nominal spending, and nominal spending will determine how the economy plays out. And so I think that's why what I emphasize is what's going on in the labor market, what's going on with wages, what's going on with the drawdown of savings. That's where my focus is very much, and less on some of these other sectors. I think it's important to recognize that many of the models that people have in their heads today are totally wrong about how the economy interacts. A lot of people, for instance, recognize that goods lead services and employment, right? So they'll look at what's going on in the goods market with goods production in order to inform them about what's likely to transpire. The problem is that goods and services this cycle are negatively correlated, right? And so actually the slowdown in goods is happening at a time when services, which matters a lot more for the economy, is picking up. And so you're actually getting a bad signal from those things. Further, they're often looking at surveys, so things like the PMIs. And survey quality has deteriorated radically in this cycle relative to previous cycles. Like it used to be, PMI manufacturing used to be 65% correlated to actual industrial production. Post-COVID, it's been zero. And there's a number of reasons to think why that's the case. But I think it's really important to recognize that the things that you've come to rely on over the course of the last, 20 years, 30 years of cycles, they are wrong. They are desperately wrong in this cycle because we have a very different cycle than the cycles that we saw in 2008 and in 2000, right? Very, very different from the cycles that most people have experienced. the one last thing I'd add is housing. Yes, housing is being meaningfully affected. Activity has gone down. The first thing I'd say is it's interesting to see how much the easing of financial conditions. So the only thing that's sort of working normal is housing. Housing is weakening. It's one of the earliest weakeners. And the thing that you see about housing, two important things. One, housing is actually quite responsive to a fall in the mortgage rate, and we've seen stronger financial conditions. And so, it's probably not going to be as bad as some people had penciled out a little bit a while ago. The other thing to recognize about housing is so many people have the 2008 crisis. People say housing is the cycle. Housing is not the cycle. Housing, represents a few million people in construction and real estate activities. Housing, if housing went to essentially zero in terms of marginal new buying purchases of homes, which is nowhere near that, but say it went to essentially, the worst of the global financial crisis, what you would see is maybe a 70 or 80 basis point rise in the unemployment rate from the housing cycle. And so it's just not that big. 2008 was magnified because you had a financial crisis in response to a housing crisis. But just having a housing slowdown is not enough to derail an economy, particularly when wages are as strong as they are and employment is as strong as it is. And so when you add those things up, I think people are they're using rules of thumb rather than focusing on the cause-effect relationships and the relative quantification of the different pieces to visualize what's likely to transpire. And that's hard, I admit.
Yeah, it's been our view as well, that housing isn't the business cycle. The reason it has so much predictive strength is that it's exceptionally interest rate sensitive, and therefore it tends to be the first thing to move when interest rates move. And then as interest rates move, it then feeds into other parts of the economy. And so it's really just a signal on overall monetary policy. And monetary policy, in our view, really is the business cycle, and liquidity conditions are what drive the business cycle. So it's a signal.
It's a signal, but it's a signal also that can have like everyone's like, well, the yield curve, as an example, the yield curve inversion predicts 100% of recessions. It does. That's right. But the issue is the lead time can be anywhere from 9 months to 28 months.
Right.
Okay, well, there's a big difference between 9 months and 28 months, right?
Yeah.
Right? We're at month 6, right? And so I just wouldn't run and say, well, it's definitely going to happen with a 9-month lead this cycle because of that inversion, like maybe. But if you go back to the 2008 cycle, the yield curve inverted in 2006, and we didn't get a recession until 2008, right? Like those rules of thumb, they're just rules of thumb. They're imperfect. They don't get the job done. They're not a granular understanding of how the market works and the different pieces and how they're all fitting together. And this is a very different macroeconomic scenario, which requires you to get down into the granular bits and pieces of how all these things are trading off through time and how they're playing out through time.
In the spirit of getting a little bit more granular, if we can talk about maybe your thoughts around what kind of the equilibrium Fed funds rate is, or R star. Do you think that's different today based on the different nominal backdrop versus pre-COVID? And if so, where do you think that number is? Do you think if the Fed were to hike to 6%, that would be sufficient? Or is it just sort of an unknowable thing and we have to see how things ultimately evolve?
Well, I think I think it's important, for all of us, given this confluence of events of a cycle that basically we've never seen, a tightening cycle or a macroeconomic cycle, inflationary cycle that we haven't seen in 50 years, combined with a lot of uncertainty about the sensitivities of the economy to tightening. It's important for us to recognize that there's a lot of uncertainty about how this is going to play out. And so my response to what level of interest rates is necessary to tip over the economy or something like that is, I don't really know. The Fed doesn't really know. And so part of what we have to do here is not be overconfident, taking a big bet on one outcome versus another, and also be responsive and careful to seeing what we're actually seeing in the real data and seeing whether we're starting to see a deterioration in the economy. So that's why, I'm laser focused every week on the initial claims data. People have a good chuckle every time I send out, every Thursday morning, I send out something that says, just your weekly reminder that the US labor market is secularly tight. And I've sent that out week after week after week because I'm looking at that data. It's timely, it's weekly. You can really stare at it. It's granular. You can look at it by state, because that's really important. Because when will the labor market start to deteriorate? The answer is not yet. When will it? Well, not yet, not soon, not a recession soon, but we're staring at that because we don't really know. We're not certain, right? Rather than, so don't get too confident. Like, there's been a big set of moves into bonds. It's like on the expectation that the recession is imminent. Like, I don't know who is so confident that the recession is so imminent. Just to be clear, I'm not that confident that a recession will occur in 9 to 12 months. I think that's what's going to happen, but I'm not that confident. So I'm staring at each one of the pieces of information as they come in to try and see whether I can get a feel of that sensitivity. So far, my answer to the feel of that sensitivity is not that sensitive to hikes, probably could withstand more tightening than currently priced. But maybe I'm wrong, and maybe my mind will change. But don't take big bets in one direction or the other. And that's what we see. We look at the most sophisticated asset managers in the world, the hedge fund community. They're running the lowest risk that they've run in 20 years because they recognize how uncertain this environment is, and that they don't want to take on too much risk given the uncertainty of the environment.
Yeah, I think that's a great answer. And I would echo how important humility is right now in thinking about bet sizing in that context, given the very wide outcome of ways things can go over the next 12 to 24 months. Coming back to what we talked about before with the 60-40 portfolio, I would add that in a way it's a portfolio that's not humble at all, because it really it works in a disinflationary backdrop with easing liquidity conditions and tightening liquidity conditions and high inflation. It's really an awful asset allocation approach, as we've observed this year, and that's why it's so important in the sense of having humility. Having exposure to assets in a portfolio that can work in this type of a draining liquidity, high inflationary backdrop can be really helpful in terms of compounding long-run returns.
Right, or at least protecting yourself from the downside, right? I think that's the most.
Which helps to then compound, but yeah, totally.
Right, which compounds over time, right? This is not a time to be greedy. This is a time to be conservative. It's a time to be diversified. It's a time to make, to hold yourself or to try and find a diversity of positions. So for instance, like when we look at, like as an example, like this gives you an example, hedge funds, they basically, they're down only a little bit in aggregate, which is better than basically every other asset class other than concentrated commodity positions. Right. Well, how have they done that? Well, they've been super conservative. So, holding a lot less bond risk, holding less stock risk. The gold stars are what their typical exposures are. The blue bars are what their exposures are right now. So they're holding a lot less stock risk, a lot less bond risk. And even in the stock market, if you look at what they're doing, they're holding, typically they're a little growthy and holding emerging market stocks and non-US stocks to get good returns. But, they've really cut back on that. They're primarily holding value stocks and small and medium stocks. Those are the sorts of things. That's all that conservatism that exists there. And I think it's important to recognize as an asset manager, you have a unique opportunity today to get diversified, right? This bounce in 60-40, you should be thinking about how do you get better protected for an outcome that isn't disinflationary growth. If the outcome is disinflationary growth, you're going to do great, right? But what if the outcome isn't disinflationary growth? What assets are complementary to your portfolio that can help you protect you in the event that we get a worse outcome, particularly around the inflation dynamic, than is currently priced. Because what's priced in right now is a return, a perfect return to 2%. And so if you're buying bonds or holding bonds today, you're basically betting at 2% that it'll actually be lower than 2%. What happens if it ends up being higher than 2%? How well protected are you? How well prepared are you for an inflationary upside environment? And when you look at what's out there, like there's so many opportunities for diversification. So here, this is just, if you took 10% of your 60-40 portfolio and you put it into these various asset classes, whether it's alpha or beta, the basic thing is buy anything other than stocks and bonds, and you will get diversification. So gold will improve your diversification, a balanced portfolio of commodities. There's also lots of alpha strategies that are out there that could improve your diversification and help improve the consistency and the quality of your returns. But that's the real thing to be doing if you're figuring out what the right asset allocation right now is to be thinking about where are those opportunities for diversification. How can I prepare today for the outcome that I haven't seen before, which is higher inflation than expected, maybe lower growth than expected, but particularly higher inflation than expected? How do I prepare myself for that sort of environment? And also, given the uncertainty, how do I find the best alpha managers to help me navigate through this environment, right? That's another key question, because it's not just about building the best beta portfolio, but it's hiring the best alphas, or bringing in the best alphas of the best managers, the most sophisticated managers, to help you navigate through that dynamic, because there is a lot of uncertainty. You're going to have to be nimble. And as an allocator, it's going to be hard to keep up with the ever-changing business cycle dynamic that we're going to see over the next 12 or 24 months. This isn't a set it and forget it time, which means that alpha, which hasn't been that useful for the last 15 years because it was a set it and forget it time, is going to be a lot more useful now because it isn't a set it and forget it time. And you're going to need nimbleness in order to protect yourself through this environment.
Yeah, it's a really helpful roadmap for thinking about portfolio construction in this backdrop. If you were to put yourself, and this will be my last question for you, Bob, if you were to put yourself in your shoes, let's say 3 years from now, what do you think the broader environment will be? And I asked that question, in the context of a recent interview that Stanley Druckenmiller gave. And he mentioned that he would not be surprised if 10 years from now, equity markets were at the same level that they are today, and that we could have a sort of lost decade, if you will, for markets, not dissimilar to the 70s, and that, similar to what you said earlier, these inflationary issues can take a really long time to play out, and it's really difficult to kind of, once you let it out of the box, it's really hard to get it back in. So if you were to put yourself 3 years in the future, do you think that we learn the lessons from the 70s, and we will, get tight enough in monetary policy and stay tight enough for long enough, and we'll ultimately break the back of inflation and we'll move on from that? Or do you think that this could be something that is with us for, 5+ years, and this is just going to be very different than the post-GFC landscape we had over the last decade?
Yeah, I think the idea, I think we are just starting to come to terms with the idea that money is no longer cheap. And the era of cheap money being over, we're still feeling the hangover, so to speak, from the era of cheap money. Like the fact that households continue to spend, et cetera, is a function of that era of cheap money and liquidity, and the fact that households and businesses continue to have relatively low debt service costs and long durations are a function of that era of easy money. And so I think the biggest thing so that's over, but it takes a little while to flow through to being over. And so if I think where we're going to be 3 or 5 years from now, the big thing that's going to be different from what most of us have known in our professional investing careers is we're going to have a structural dynamic where money isn't cheap. And that, where we're going to have positive real rates, where we're going to have elevated, priced in inflation, right? Where interest rates, nominal interest rates are going to be, 5%, 6%. That could be a very normal dynamic. And very few of us have thought carefully about all the second and third order consequences of how the end of cheap money and the era of more expensive money will flow through to all the different ways in which the economy operates. And so that's really, when I think about 3 or 4 or 5 years from now, we're going to see a very different economy when it comes to asset valuations, when it comes to borrowing, when it comes to which economic activities are rational at the economic activities that are rational at 5 or 6% yields are very different than the economic activities that are rational at 0% yields. And we're just getting adjusted to that. And so I think the idea that we could have sort of a lost era of asset prices, particularly stock prices, as the economy is adjusting to those, to that new dynamic, that seems totally plausible. Absolutely plausible. I think it's important to recognize, if you look back through time, the last 100 years, equities have been in a meaningful drawdown in real terms in 50 of the last 100 years, right? So it's totally normal for equities to suck for extended periods of time, right? It's just it's like we forgot. I remember standing in 2009 talking to people who are like, yeah, I haven't made a dime in equities in at least a decade, if not longer. Like in the 70s, it went on for 15 years. It's very normal for equities in a real return basis to be terrible. And so the question is but you don't remember that because it's been 15 years of good years, right? So how do you prepare yourself for a possibility that equities have meaningful negative real returns over the course of the next 10 years? It's not the 60-40 portfolio. It's not at all that. It's adding alpha and inflation-sensitive betas to what you're doing.
Yeah, I think we would agree with that wholeheartedly. A balanced exposure to commodities, we think, are a great way to augment a 60-40 portfolio. Various types of alternative and absolute return-oriented solutions that can generate alpha without equity beta. Things like that definitely have a place in multi-asset portfolios, probably now more than people are used to over the last 15 years. So with that, Bob, this was fantastic. Thank you so much for joining. Really appreciated your insight. And we look forward to hopefully being able to host you again and pick your brain again in the future.
Thanks so much for having me. I really enjoyed it. And if folks want to see the evolving set of thinking, definitely check me out at Bob E Unlimited on Twitter. And if you want to learn more about what we're up to at Unlimited, you can check out more information about what we're doing at unlimitedfunds.com.
Perfect. Thank you, Bob.